I'm Nicole Lappin, the only financial expert you don't need a dictionary to understand. It's time for some money rehab. All right, what do Warren Buffett, one of the greatest investors of our time, and Micheal Burry, the guy in The Big Short who predicted the housing crash, have to say about today's market? You know what? They're both concerned. And because of the investing track record and the gravitas of these guys, that then makes everyone else concerned. But let's unpack what they're both really doing here. Buffett's strategy has always been to buy companies or shares of companies below their intrinsic value. That's the basic premise of his favorite strategy, value investing. But in our current stock market, most stocks are right now trading above their intrinsic price, which has kept Buffett on the sidelines waiting for his shot. Now, that waiting game hasn't hurt his company, Berkshire Hathaway. They're still making tons of money, and the value of their shares continues to rise, even though a price of one Berkshire Hathaway A share is super, super expensive. At the time of this recording, just one share of Berkshire Hathaway Class A stock is $550,000. It's actually more than that, which is bananas. Anyway, in the company's latest disclosures in August, Berkshire Hathaway reported selling $8 billion in stock, which has raised the amount of cash they have on hand. And that's the thing that's freaking most people out. If Warren Buffett is selling his stock, should I? Short answer, no. His company has been on a long selling streak for the last 3 quarters, with sales totaling some $33 billion in sold shares. They're still buying, though, with a reported recent investment of $10 billion in U.S. Treasuries. This suggests that Buffett is betting against the U.S. stock market in the future, but seeing more opportunities to make money in the bond market than in the stock market. Burry is also betting against the stock market. His company, Scion Asset Management, bought put options with a total value of $739 million on QQQ and another batch of put options with a value of $886 million on SPY. As you know from the show, SPY and QQQ are exchange-traded funds that track the broader market. A put option, which we've also talked about on the show, and we have a whole M&N show about this, We Have Options, which I've linked in the show notes, is a way to basically profit from a stock price going down. It's a contract that gives the holder the right to sell an asset at a preset price below its current value. While this is really telling and people have been worried when they saw these headlines, remember, there is a lot here that we don't know. Funds like Scion Asset Management are required to file financial disclosure forms that broadly say what they bought and sold each quarter. Scion's disclosure doesn't tell us, though, how long these put contracts are for or even what they paid for them. So this could simply be a way of them hedging against a market downturn. We just don't know from the information available. We do know that Burry believes that the market is overheated and due for a retraction. This is also a broad bet that the market will retract, since these are funds that track the performance of the entire index, not just a small slice. Now remember, markets go up, markets go down. They retract. That's what they do. That's their nature. And historically, I will say that September is the worst month for the US stock market. It's possible that we could see a retraction by the end of the month. While most economists are not projecting a recession in the near term, it's probably wise to think about all the ways you can hedge your own investments, just like Buffett and Burry. And you can also do that using Buffett's trick of investing in treasuries. Buying treasuries is one way to make sure that whatever you invest in will have a guaranteed return in the short term. For today's tip, you can take straight to the bank. If you're looking for a little extra protection out there, you can always look to put some of your cash into a money market fund. These are funds that function much like a savings account, but they invest your money, meaning they pay a little bit of a higher interest rate than a savings account. They are not, though, FDIC insured, so I don't recommend putting every dime you have in there, but they're widely considered to be a safe way to earn a little extra money on the cash you do have sitting around. Money Rehab is a production of Money News Network. I'm your host, Nicole Lappin. Money Rehab's executive producer is Morgan Lavoie. Our researcher is Emily Holmes. Do you need some money rehab? And let's be honest, we all do. So email us your money questions, moneyrehab@moneynewsnetwork.com, to potentially have your questions answered on the show or even have a one-on-one intervention with me. And follow us on Instagram @moneynews and TikTok @moneynewsnetwork for exclusive video content. And lastly, thank you. No, seriously, thank you. Thank you for listening and for investing in yourself, which is the most important investment you can make.